Index funds offer a way to build an investment portfolio that does not depend on the performance of individual stocks or bonds. But not all index funds fall under the SAFE umbrella. Here are 9 top-performing index funds that are poised to weather turbulent times while delivering robust long-term results, regardless of economic fluctuations. Number 1. Vanguard SP 500 ETF VOO. Renowned investor Warren Buffett advocates for the Vanguard SP 500 ETF as one of the best investments for the average American. This ETF mirrors the S&P 500 large cap benchmark index by investing in all 500 constituent companies. It boasts an incredibly low expense ratio of 0.03%, which translates to a mere 30 cents in annual fees for every $1,000 you have invested. Despite its reputation for stability, the S&P 500 isn't immune to short-term volatility. Historically, the index have experienced periodic drops, including one such occurrence in 2022. However, over the long term, the S&P 500 has demonstrated remarkable consistency, delivering annualized total returns of 10.5% since 1965 and creating tremendous wealth for investors. Number 2. Vanguard High Dividend Yield ETF VYM. The Vanguard High Dividend Yield ETF follows an index composed of stocks with above-average dividend yields. With a nominal expense ratio of 0.06%, the fund invests in a diversified portfolio of 443 different stocks. Notable holdings include JP Morgan Chase, Broadcom, Home Depot, and ExxonMobil, with no single stock accounting for more than 3.1% of the fund's assets. As you would expect, the fund boasts an attractive dividend yield of 3.3%. Dividend-paying stocks typically do better than other stocks during tough market conditions. This is exactly what happened during the 2022 bear market when VYM outperformed the S&P 500 by nearly 10 percentage points. But this resilience does not compromise long-term performance. While dividend-focused ETFs may underperform during bull markets, they historically deliver comparable total returns to the S&P 500 over time. If you want strong long-term returns with lower short-term volatility than the overall stock market, the Vanguard High Dividend Yield ETF is an appealing option. Moving on to Vanguard Real Estate ETF VNQ. Including real estate investment trusts in an investment portfolio can be highly beneficial when you're looking to minimize risk. REITs typically offer higher dividend yields compared to standard S&P 500 stocks and demonstrate lower volatility, particularly in challenging market conditions. And over time, REITs have slightly outperformed the S&P 500 index. The Vanguard Real Estate ETF tracks a carefully weighted index consisting of 162 REITs. Notable holdings within this ETF include companies such as Prologis, American Tower, Equinix, Public Storage, and Simon Property Group. Because REITs focus on distributing income to shareholders, the fund delivers a competitive dividend yield of 4.14% as of December 21st, 2023. Additionally, with an expense ratio of just 0.12%, you stand to retain a significant portion of your returns generated by the stocks underlying the REIT. Number 4. iShare Core S&P Total US Stock Market EFT with ticker symbol ITOT. Rather than picking individual stocks or a specific benchmark index, one strategy to mitigate risk is to invest in the entire stock market. This approach can be achieved through an index fund that mirrors a total market index, like the iShare Core S&P Total US Stock Market ETF. Although the overall market may exhibit volatility in the short term, it has historically delivered impressive long-term returns. True to its name, this EFT seeks to replicate the performance of the entire US stock market. It holds a diversified portfolio of nearly 3,400 stocks, spanning from large-cap industry giants to smaller-cap enterprises. It has an expense ratio of 0.03%, which is among the lowest in the whole EFT industry. Moving on to the Consumer Staples Sector SPDR Fund with ticker symbol XLP. If you're worried about safeguarding your investment during recessions or hard economic times, consider companies that sell stuff people need. The consumer staples sector is chock full of such companies, and this makes the Consumer Staples Select Sector SPDR EFT an attractive index fund for investors. With a modest expense ratio of 0.10%, this ETF falls on the lower end of the scale for index funds in this sector. It focuses on investing in consumer staples companies listed in the S&P 500 index. Notable holdings include industry giants like Procter & Gamble, Costco Wholesale, PepsiCo, Coca-Cola, and Walmart. These companies tend to perform consistently well regardless of economic condition. Let's move on to number 6, iShare 0 to 3 month Treasury Bond ETF with ticker symbol SGOV. When seeking secure investment options, the iShare 0 to 3 month Treasury Bond ETF ranks as one of the safest alternatives, comparable to holding cash in your portfolio. This ETF invests in a selection of Treasury securities that matures in 3 months or less. As you might expect, this ETF serves more as a substitute for cash rather than a vehicle for long-term wealth accumulation. Investing in Treasury securities is extremely safe. Their short-term maturity profile means your investment experiences less fluctuations in value due to interest rate changes compared to ETFs holding longer maturity bonds. Last year, the fund dividend yield was around 4.93% and would likely change as interest rates move higher. It has a nominal expense ratio of 0.05%, making it an appealing option for deploying your cash in a risk-free manner compared to investing in bonds. Moving on to number 7, Vanguard Utilities ETF with ticker symbol VPU. Few businesses demonstrate as much resilience during economic downturns as utilities. Regardless of economic fluctuations, consumers and businesses continue to rely on essential services like electricity and gas, which are often provided by quasi-monopoly utility companies. So if you are seeking safety, consider Vanguard Utilities ETF, which tracks the utility sector. This index fund boasts a modest expense ratio of 0.10%, making it an inexpensive choice among ETFs tracking the utility sector. It consists of a diversified portfolio of 65 utility stocks with a median market capitalization of nearly $35 billion. Key holdings include NextEra Energy, Southern Company, Sempra, and American Electric Power Company. Generally, utility companies focus more on paying dividends rather than spending heavily on things like research and development. Because of this, they tend to offer higher dividend yields. As of December 2023, the Vanguard Utilities ETF boasted a dividend yield of 3.70%, making it an attractive option if you are seeking both income and stability. Number 8, iShare US Healthcare Providers ETF with ticker symbol IHF. Healthcare is often regarded as a recession-resistant sector. However, it's essential to recognize its broad scope, encompassing various stocks with different levels of risk, such as pharmaceuticals and biotech companies. For investors prioritizing safety, a more targeted approach may be wise. The iShare US Healthcare Providers ETF specifically tracks stocks involved in healthcare provision, diagnostics, and healthcare insurance, which are essential services unaffected by economic downturns. Despite its narrow focus, the fund offers diversification by holding a basket of 70 healthcare provider stocks. It has an expense ratio of 0.39%, making it the highest on our list, but this aligns with similar specialized ETFs. Typically, index funds with a narrower focus have higher fees. Notable holdings in this ETF include United Health, Elevance Health, and CVS Health, all prominent players in the healthcare provider space. And finally, number 9, the Schwab USTIPS ETF with ticker symbol SCHP. With inflation at its highest in over 40 years, many stock investments have faltered. But holding on to cash isn't great either, since inflation erodes its value. The Schwab USTIPS ETF could be a solution for those of you looking to hedge against inflation. This ETF invests in an index tied to inflation-protected Treasury securities, offering a reliable defense against the erosive effects of inflation. As inflation subsides, the fund's yield will likely decrease. However, if inflation persists, you can rest assured that your money remains safe. The fund maintains a modest 0.04% expense ratio, so it's a relatively inexpensive option if you are seeking peace of mind in these inflationary times. Go ahead, leave us feedback and share your list in the comments. And if you find this information helpful, smash the like button, subscribe to the channel, and share the video with someone who can benefit from it. Until next time, stay financially savvy. We'll see you in the next video.